Hi everyone, Geoff here from GCT Property. Today we've got our industry expert in terms of the finance world, so welcome along Dylan from Westpac. Thank you, Dylan.
Thanks for having me.
So I have a lot of questions recently from clients about the changing interest rate environment. Financing a property is really critical, and we are in a changing interest rate environment. We all understand that, so it's really good to and really important to have the right finance advice. It can save you thousands of dollars per year. So I'm always constantly looking at my refinance rates and seeing what we can do. So we're going to run some questions past Dylan, the expert, and give everyone some clarity and confidence in the property market, essentially. So just a general disclaimer at the start of the presentation. So the information that we're going to provide today is generic in nature. We don't understand your individual borrowing requirements, so we always recommend that you refer back to the finance expert in individual cases. So first question, Dylan.
Yeah.
Can you please explain the assessment rates, how banks assess us as borrowers, and the difference and the importance and the benefits of having that higher assessment rate?
Yeah. When you come into the bank, obviously we're going to discuss your individual borrowing capacity, and to protect you from not being too worried that you won't be able to afford the loan in the future, we do put a 3% buffer on top of the revert rate or the variable rate. The revert rate is, if you think about when you go into a bank and there's a 2-year introductory rate or there's a special offer that only lasts a short period of time, we have to assess on with that removed, and or when you fix a loan, when the fixed maturity date comes, it'll go to a variable loan. We'll assess on that rate. So that's the rate that we use in the assessment plus 3%, just in case the rates are to go up, which with the current conditions in the environment we're in, we do know that they will go up as the RBA continuously announces increases. We assess the 3% on existing. So if you have an existing investment or owner occupied, we will assess the 3% buffer on that, as well as the new loan that we take out. And there is other buffers that we do consider on other liabilities like your credit cards and personal loans.
Okay, great. And again, that I think helps protect the Australian property market, being a good thing. So the next question related to that is obviously with these increasing interest rates, it is going to decrease clients' borrowing capacity. So if you could just explain that. And the reason for that is people that have got a pre-approved loan and they may sit on the fence and wait 6 or 12 months may find their borrowing capacity greatly reduced, which limits their property purchase options in the future.
So there's good and bad to this. The bad side is obviously the rate increase when it's variable or revert rate. Plus 3% is naturally going to be higher, reducing borrowing capacity. So that's the bad side. But the good side is that it hasn't fluctuated as much as we thought it would.
Great. So
that 0.5% in some scenarios has only been a 40 to 50k borrowing reduction on a 500 or 600,000 loan. That's with the 0.5 to a 1% fluctuation. I would definitely recommend to use strong buffers in your assessments and ask the lender what assessment rate they are using so that you can consider a true or real rate for the variable plus the 3%. So for example, if you went in today and they said your maximum borrowing capacity is X, ask them what rate they've used and if there is any buffering just in case rates were to rise by 0.5 to 1%.
Okay.
And they can tell you if they should be able to tell you the difference between a 1% rate change in your borrowing capacity, and I would definitely ask them that scenario.
Great. It's great advice for those considering property. Should they buy property now or wait down the track? If you've got borrowing capacity now, yeah, sure, property prices may drop, they may not, but if your borrowing capacity is reduced in the future, it can really reduce your options. Now the next question is, the last time I went through a loan was in about October last year, and I found it a much easier process with the electronic document downloads. Prior to that, it was a very complicated system to go through a refinance. I personally think it's a much better system now. So can you just briefly explain how all that works, Dylan?
Yeah, the bank has made it easy for customers. We feel comfortable in our own homes. So we send you a link, you click on that link and you fill out the questions in which you used to do face-to-face. You can still choose to do this option, but a lot of people might not know the information, maybe sitting in front of someone in a desk format. So it's nice sort of finding your documents in the comfort of your own home, and the system that we call Prepare Online or Apply Online at Westpac does tell you what we need in the appointment or for the application, and it goes through a step-by-step process as to the information required, and it can even give you repayment calculators and a potential borrowing capacity or costs, and it actually gives you information as you go along so you can see how it's tracking. And if it doesn't work out, don't worry, I'll be calling you or someone will be calling you to help you to fix up or to educate as to why it's working or why it's not. It is a very fluid process, and you can upload the documents at Westpac and it goes straight to the lender who's helping you.
Yeah, so I found it a much easier process rather than have to download from each bank if you've got several lenders. One link and just automatically downloaded every account and every statement and all your loan repayments, etc. It was a much simpler system. I think it's a great incentive that the banks have brought in.
It's a lot quicker too. Westpac is talking of quicker mortgages, and this is the system that is helping to assist in people getting a faster approval. And luckily, it's if you do click the link and go through that process, a lender can verify the documents themselves, because that is the application system that we use for home loans. That you're actually putting the information in. So it's directly going straight into a home loan application, which we don't have to click submit on if they don't want a credit listing. We can just do a serviceability from it as well. But if you want to, then you can apply straight away and it's already in.
Okay, I think it's a much better system. Now, the next question is on these interest rate rises. We just had a discussion before the interview about the difference between principal and interest-only loans. Really interesting scenario. So we've done a case study on a property worth $700,000, borrowing 80% of that, so the loan value at about $560,000. So Dylan's going to explain the two different rates between interest-only and principal and interest, the difference between the monthly repayments, which is much less significant than we would have thought.
Yeah, it is quite interesting. Obviously, this is as of today, but the interest rates with our interest-only Flexi First, which is a simple product. So we've got variable and interest-only fixed rate. So the 2-year fixed rate, is 5.69%, and that repayment was $2,497 per month. And in comparison to our variable rate, which was the Flexi First I was talking about, that's 3.64%. So there is a bit of a difference there. The repayment to that was $2,600. So we saw a difference of about 220, but this 220 was considered when we put the 0.5% RBA announcement that came out only a couple of days ago. We would have to probably cater for this in your repayment. So when we assess, we would maybe want to use a 4.14% rate, even though it's not actually the offering. But that's the sort of stuff that Westpac or a lender would need to help you out with, knowing the potential future or the near future of interest rates. So really what that's saying is that the difference between an interest-only 2-year fixed rate and a principal and interest variable loan, it's $220 per month as a difference. And the last example was that if we were to use the principal and interest 5.69% interest rate, which is the same as the interest only 2 years, it was $3,247. So it's looking about $500 to $600 different to choose a principal and interest at the same rate as the interest only 2-year fixed rate. So it is a little bit more.
Yep.
And that's why when we come in, we do like you to have an understanding of your financial situation and to ask us questions as to which one might be suitable to your serviceability assessment and or to your financial situation.
Yeah, I know personally sometimes I'm better off on my investment properties with principal and interest. Sometimes in the past I've been better off with interest only. So it's a really case by case study. But that just those figures that Dylan quoted just show the difference when you get your finance, and it can be massive. You should always be looking at your refinance. I would recommend every 6 to 12 months having a look at the current finance structure and see if you can improve it. So thank you for that, really important point. Lastly, we're going to cover on the benefits of refinancing. So I know that all the banks are very competitive at the moment, which is great for us as consumers or property buyers. Dylan's just going to explain a little bit about why some of the incentives and why you would currently look at refinancing in the current market.
Refinancing is obviously a big thing at the moment. Worried about the rates, and we do interest comparisons. So we do like to calculate how much money you would save when you refinance to Westpac. But we'll give you $4,000 to do the process with us, which is a lot of money. And generally to refinance, you have got costs. And generally speaking, if you've got a variable product, a major bank or a bank of similar, they're about $750 in total costs to refinance over, depending on what state you're in. So $4,000, it will definitely cover that. You'll come out with about $3,200. Hopefully, if you're in a fixed rate, we'd have to discuss that. But the $4,000 cashback's the first thing, and then there is a Premier Advantage package that you can choose, which is obviously part of the fixed rates, which is a $395 annual package fee that the bank will give you benefits like an annual free credit card and monthly account fees waived, and You can get all these other benefits with your insurances and stuff like that, and we can waive that for the first year for purchases and refinances. So that's a benefit for all for coming to Westpac.
Right.
And then that package fee is only for the, let's say it's 2 people coming in and they're a joint loan, the one fee for both of them for all of their loans.
Okay.
So you don't pay that for 2 people, you pay that for the package people per year for all of your loans for in continuity, so every annual.
Great. Thank you, Dylan. That's been really helpful. I've always said to every property owner and investor, finance is really critical, a key part of it, especially with these changing times. Still, a great time to look at the refinancing, even more important, but have the right advice. So thank you, Dylan, for coming in.
Thank you.
Been great.
So much.
Thank you.
Appreciate it.